successful operators, and we hope to put ourselves in that category over the next couple years here, are really going to have to segment in their mind, your existing portfolio and then also the opportunity you have in front of you. I think it's really easy to sit there and say, hey, when prices come down, we're going to jump in, right? But when you've got a portfolio that, maybe has some floating rate debt on, maybe the business plan isn't going as well as you thought it would, it's a lot more difficult to actually jump in when you see opportunity that is clear.
Exactly what operators should be doing to prepare for the opportunities that are coming is what we're going to talk about today on the Daily Real Estate Syndication Show. I'm your host, Whitney Sewell. Our guest today is Kevin Dean. He's a founder of Rockbridge Investment Group, 2,600 plus doors, $250,000 in real estate transactions, previous experience in chartered financial analyst program, previous experience on pricing desk at Fannie Mae, involved in over $500 million plus in agency debt transactions. And so, it's included all kinds of different types of debt that he's been a part of, in previous careers, but experience structuring $400 million plus in multifamily agency debt. It's some great skills, especially right now when we're looking at multifamily or any kind of commercial real estate. I had a great conversation. I know you're going to learn a lot from Kevin today as we talk through, what you or your operator, if you're a passive investor, what they should be doing to prepare their current portfolio ultimately, so they're prepared for new opportunities that are going to be coming. Kevin, welcome to the show. Honored to have you on. I know you and I got to meet a little while back, and I'm grateful for that, for you reaching out when you were in my area. I'd welcome the guests to do the same, or the listeners and any guests. But Kevin, welcome to the show. I'm looking forward to diving in. Honored to have you.
Super excited to be here, Whitney. And yeah, that was a great time getting together. It's such a small world in the multifamily real estate industry. So we both know a lot of the same people. So it was great to meet you back then and excited to be talking with you again today.
Yeah, you as well. So thanks again. Well, with your experience, Kevin, even at Fannie Mae and, 2,600 doors now, $250,000, real estate transactions, I'm looking forward to diving into this conversation today because I know so many of the listeners, it's just questions all the time about, what to do, right? What's going to happen? Everybody wants to know. I think that's the most popular clickbait, right, on YouTube and everywhere else, is the houses that are on fire and people saying the end of the world is coming and all this stuff, right? And so I'm looking forward to just thinking through this today with you. Like I said, with your experience, so I'd love to know your thoughts on what successful real estate operators are going to be doing over the next 6 to 12 months, and it's just dialoguing a little bit on that thought and what you see happening.
Absolutely, and yeah, over here at Rockbridge, we're always just kind of speculating and talking about what we think the economy is going to do and where we can position ourselves best. So, of course, we always have a view of what we think is going to happen and, how do we position ourselves properly. But the truth is we have no idea. There's lots of conversations about interest rates and cap rates and occupancy and new supply coming in. And, while we can certainly look at a ton of data, if we've learned anything over the last few years, it's that we are terrible at projecting where interest rates are going to go. So don't even try. So with that said, in terms of, what our successful real estate operators are going to do the next couple of years, in our opinion, we think that successful operators, and we hope to put ourselves in that category over the next couple of years here, are really going to have to segment in their mind, your existing portfolio and then also the opportunity you have in front of you. I think it's really easy to sit there and say, hey, when prices come down, we're going to jump in, right? But when you've got a portfolio that, maybe has some floating rate debt on, maybe the business plan isn't going as well as you thought it would, it's a lot more difficult to actually jump in when you see opportunity that is clear. So in my mind, what we're trying to do is, one, our existing portfolio, any assets that are either not operating exactly where they need to be, any pending debt maturities that need to be handled, we're doing everything that we possibly can to address any potential issues that are going to surface in the next, 12 to 36 months. And that is, we're aggressively going after getting debt sized every single month when we get refreshed financials, making sure we're staying on top of asset management and construction management, making sure we're still spending the time doing the relationship building with our on-site team. And then on the flip side, we're also cognizant of the fact that there's a lot of people who are struggling on the operation side, and that is going to present some opportunities, and it already is, to be honest with you. So that's kind of what we think, successful operators will do in the next couple of years, is really just segment existing portfolio from new opportunities and make sure you're aggressive on both sides.
Love that. I think it's very wise and a good thought process right now to think through. And I'm sure most operators are thinking through their current portfolio, right? But they're probably not making the connection to how the issues that are most likely going to come up with, whether it's their debt or whatever it may be, how it's going to affect the new opportunities, like you said, that they won't be able to go after those new opportunities because their pants are on fire over here.
Right.
Right. I mean,
Yeah.
They won't.
Yeah, I mean, it's exactly right. And I think, that comes back to one, making sure that, you have the right team to execute on the existing portfolio and then also on the new opportunities. So one of the things we've done over the last year, and one of the things that we're going to continue to do, is just make sure that operations are tight on our side. We've got good systems and processes. We understand, who on our team is responsible for what, and just making sure that, we're in a position to actually execute on great ideas, because everybody has great ideas, right? But I know we're guilty of having great ideas and sitting on a meeting and discussing them, but then actually implementing them, it doesn't always happen. So yeah, I mean, I'd love to kind of get into a little bit more about where we see the opportunity and how we're setting ourselves up to execute.
Yeah, love that thought as well. Where's the opportunity going to be, and how are we setting? How are you setting yourself up to execute on that? And maybe before we hit that, I was thinking again about, you talked about segmenting current portfolio and opportunities. You talked about the team members that are, having the right team, right, to execute on the current portfolio. Have you seen that? Now that maybe people aren't doing as many deals right now, I've heard, and we're guilty of this as well, but, using maybe the team resources we have right now on the acquisition side to help us with some asset management, right, as well. And my thought process recently, this is so timely, right, that you're talking about segmenting this, but my thought process recently is like, well, when new deals come, I want them to be able to be laser focused. Right. I don't want my analysts or director of acquisitions, whoever, to be so, into the asset management piece that, we miss all these opportunities, right? Or they're real focus. Have you seen that, or, how are you separating that, or maybe keeping that team busy right now?
Yeah. So, I mean, one of the things about Rockbridge is we've had to be pretty scrappy to get to where we're at. So when I started Rockbridge, I had a full-time job. So in the beginning, we really focused on a joint venture relationship to where, we were able to take on the capacity that made sense for us to take on. And then we partnered for some of our weaknesses, right? So the good news is, at least for us, we're set up in a way to where we're not bogged down in one single deal too much. And we've maintained our flexibility and kind of our ability to be nimble. But at the same time, to your point, we have floated back and forth, but we float back and forth between asset management, acquisitions, CFO, construction management every single day, because we are a smaller shop. And while longer term, I think that we will get a little bit, maybe more segmented internally, I think it's actually been a benefit for like a smaller and a growing team, because when I first started doing deals, I had no asset management experience. I knew how to put something through a model. I knew what made, the underwriting model spit out a pretty 15% IRR with good cash on cash return. But I really had no idea what bad debt was, or how difficult it was to actually turn a unit properly and in a timely fashion. So I do think that there is value, kind of like you mentioned, having maybe your acquisitions guys adding some, assistance on the asset management side, even if it's only temporary, because that will inform their ability to really underwrite deals, structure a business plan, and know what's actually achievable.
Yeah. Yeah. No, love that. Love that. Well, I want to jump on into, where you mentioned, where's opportunity going to be, and how you all are preparing, right, to execute, which we've talked about a little bit. Maybe it's team members, whatnot, but we'll start there.
Sure. So over this last year, we went from, I think we acquired something like 13 deals in 18 months. And then we had about a year with nothing done at all. But in that time period of 12 to 13 months with no new acquisitions, we probably over, that period underwrote over 500 deals and submitted well over 150 LOIs. So while we've effectively been out of the market by how we're underwriting deals, we've seen a ton of different types of deals in different markets that we're interested in. So one of the things that I've noticed is, at least for us, the straight down the fairway value add, where you're putting in $10,000 to $15,000 a door of renovations, you're improving the operations, you're taking it from a classic unit to a premium unit. We're running into affordability issues when we're underwriting those deals, and we can't justify to ourselves doing the value add 5.0 or 6.0 to a property that's already had it done a ton of times. So what we're seeing work, and we actually have 2 deals under contract right now that kind of illustrate this, is either one is deals that are brand new, say 2020 to 2023 construction, that are either coming out of lease up or, they were bought out of lease up and were purchased with maybe floating rate debt, and now they need to sell. But there's really not a major value add. You're essentially just buying the deal at a really good price. You're removing loss to lease. You're buying in a great market, and you're just operating it as well as you possibly can. We're finding that those deals are starting to generate, one, a pretty decent year one yield, and two, a good IRR, because we're buying it at a good basis. So on that side of the acquisitions sort of framework, we're focused more on basis. What are we paying on a dollar per square foot basis for this brand new asset, and how does that compare to new construction? And then we're also just focused on lengthening our hold period a little bit longer. So it's more like a coupon clipper where, yes, it's still going to be, hard work to make sure you keep it occupied. You still got to do a great job, but you're not putting in $15,000 a unit. So that's one side. On the other side, what we're seeing, and we have a deal that kind of illustrates this under contract as well, is the deep value add deals where, you're buying it at a very low price. You're putting in, 50 to 60,000 per unit. Maybe you're taking occupancy down to 10%, and then you're leasing it back up. So what we're seeing is kind of like both ends of the perspective, either, heavy value add, or no value add, but you're buying it at a great price.
Wow. No, I love that. I love how you laid that out. We're very focused as well on more so the first strategy. We've talked about the second, but it's true, right? I think also a lot of developers have gotten in over their head, at the moment, and it is unfortunate, right? That a lot of them are going to lose money or sell, with no profit almost, right? Are going to have to, and almost what you're talking about, right? During the lease up period or right after it's been leased up, and what I love though, after we've done a number of the deep value add deals, it's like. It sounds so nice to have more deals that are like just a few years old or less.
Absolutely. I mean, it's not as easy as everybody makes it sound to renovate, 150 units over a 2 or 3 year period and then sell it for twice as much money. Like that takes a lot of coordination. And it honestly, what it is it's more risk, right?
Yeah.
So like whenever we're looking at deals, we're always looking at it from a risk adjusted basis. So if we can take a brand new 2023 construction with, no major capital needs and generate a 15 IRR with this over a 6% cash on cash in year one, or we could get a value add deal where we're renovating, say 75% of the units at 15,000 per unit, and we're generating, say, an 18 IRR. I would take the 15 all day over the 18 for a couple of reasons. One, the business execution risk is significantly reduced. Two, you can probably put better debt on it up front that, makes more sense and reduces risk. And then three, going back to kind of the beginning of our conversation, when you're just looking at your team and you're not this giant publicly traded company, you only have so much capacity, and you want to make sure that you have the capacity to actually provide your investors what you said you would provide them. So, yes, we'll take the 25 IRR if it's a value add deal, but if we're 2-3% higher, we'd rather go for that brand new Class A kind of deal.
Yeah. I think so often, we see that, say the 18% IRR or whatever, investors want to jump in there. But I think a lot of them, especially right now, they're feeling that, right? They signed up for that deal, but they're not getting that anyway at the moment. Right. So, I agree with you completely. It's also such a stretch on management, right, to make that happen on deals like that. The deep value adds, and I just think more management, unfortunately, teams are not prepared for that kind of process, as much as they want to think they are. And we've had some hard lessons there. I mean, no doubt about it. And I think it depends so much on your operating team or the on the ground boots on the ground, right, to make that happen. And that's also why there's so much more risk, right? It's so much easier to manage a brand new asset, different type of tenant, all these things, right? You're not vacating and doing renos, all that stuff. So it is a property management nightmare, I think, to do the deep value adds.
Yep, absolutely. And I mean, just to give one tip for something that we're doing, the deal I mentioned that is the heavy value add, we're taking the property down to about 10% occupancy, and then we're going to be adding 155 bedrooms to the property. So, taking a lot of the twos and making them threes, and then certain units that are on the basement floor, we're actually going to be punching into like a big utility closet and adding a fourth bedroom. So for something like that, I think the key is like know thyself, right? And for us, we have some construction experience, but we knew that we needed to partner on this deal with somebody who's actually done development before. So we've got a development partner on this deal, and then we're actually hiring a construction manager who we're paying, a lot of money, $20,000 a month, to just sit there, manage subcontractors, manage the GC, make sure things are moving along. And for us, $20,000 a month is a lot for a single deal, but we work that into the construction cost because we want to make sure we're covered, to where we can actually execute on that business plan. And if it's up to me or somebody else on our team who doesn't have that hands-on experience and isn't going to be able to live at the property for a year, it's not going to happen. So we're willing to pay up to a professional who's going to steer us in the right direction, make sure we avoid, landmines, and really make sure that this project is successful.
Love that. I appreciate you mentioning that, because 20,000 a month sounds like a lot, right? However, that's a lot less than you're going to pay if you don't have that expertise on the team.
100%. I mean, I can tell you that he has already saved us well more than that, in a couple months. So it's absolutely worth the spend to get the right people in who know what they're doing.
Yeah. Speak to finding how you are going to find even the newer deals.
So what we're doing is, I mean, I think it goes back to what we've been doing the last 5 years, really, which is just building relationships. We have acquired 19 properties over the last 5 years, and I think probably 5 of those have been direct to seller. Everything else has been through a broker. So, our goal on the acquisition side is we want to provide feedback. So, general pricing and terms within 48 hours. And it may not be super, super detailed, but we want to at least let them know, hey, we hear you, we see that you've brought us this opportunity, and we want to be responsive and not take that for granted. And maybe over the last year or two, a lot of people were doing that, but now that there's not as many people who are really underwriting new deals, getting aggressive on the acquisition side, and providing feedback, even if it's 20% below the whisper price, what we're seeing is we're starting to get more first looks at those deals. So the short answer to your question is just working with brokers, just like we always have. And we're still doing some direct to seller, type of stuff where we're taking sellers out to lunch, letting them know who we are, that sort of thing. But most of our deals have come through our broker relationships.
And I assume the deep value adds y'all are looking for same.
Exactly the same. Yep. Actually, that deal actually came from our lender that we used on a prior deal. So he actually originated the loan. It's maturing. It actually, it's basically at the end of its maturity. So he presented us this opportunity, just given he knew that, they were either going to have to refinance or sell, and they knew that we could execute on it. So that one actually did come from our lender.
Wow, that's awesome. You never know, do you? Right? It's keeping those relationships hot and connected, and you never know. So, what about investor sentiment that you've noticed? About maybe both of these types of strategies.
So, for the strategy that is more the Class A, lower risk type of opportunity, I should mention the way that we kind of segment our deals is we have kind of 2 buckets. So, we either say, hey, this is more of like a high net worth syndication type of deal, or this is more of a, institutional equity type of partnership. So for deals that are what I would say lower risk and probably lower return, that's more of like our syndication type structure. And the reason we do that is most of our higher net worth investors, accredited, non-accredited, they want to get some cash flow. They want to get a decent IRR, but it's a combination of wealth preservation and, getting some cash flow. The institutional equity groups, they're experts at evaluating multifamily deals. So if we bring them what we would consider to be a higher risk deal, we know that they're getting into this just like we are, not fully understanding the risk. So for example, that deep value add deal, that's not really one, I won't say never, but it's one that we wouldn't typically bring to kind of our syndication investor group, even though it's a great return, just because the nuances of that deal, it takes hours and hours to understand. And we didn't want to, basically pitch that to an investor who didn't have the time to fully vet the opportunity. So in terms of investor sentiment on the kind of class A typical, syndication type structure, we're definitely seeing demand. And I think part of that is we haven't brought as many deals to the table in the last year. And while people are definitely a little bit more risk averse than maybe they were a few years ago, people do have cash that they're looking to invest.
Yeah, no, we've seen that also. So we've had less deals over the last 18 months than we've ever had. And yeah, it's like every investor call, it's like, oh, well, what's, when's the next deal?
Right.
Or it's like, well, we don't know, but we're working on it.
Right. And I think the key is just, we all want to sleep at night, right? So there's no reason to stretch for a deal just because you have investor demand. It's a great problem to have.
Right.
But we, our goal is we want to be in this business for a really long time. So that means we need to pass on, 200 deals until we find the right one. That's okay for us.
That's right. Completely agree. Well said. Kevin, what's your best source for meeting new investors right now?
I would say our best source comes from executing on our current deals. So referrals is absolutely the number one source for us. I think it's taken some time to get there. We've been in business now for 5 years and we actually haven't sold anything. We kind of we have a longer term hold strategy, but we have investors that are getting, in some cases, hundreds of thousands of dollars of cash flow every single year from our deals. And that's really the most important thing to get new investors, is just doing what you say you're going to do, following up. We like to take a really personal approach. So we know all of our investors individually. We don't do much marketing. Somebody from our team has either had a Zoom call, a coffee, a lunch, a dinner with every single investor on our list. And one that helps solidify the relationship with those investors, but it does also lead to referrals.
What's your best advice for passive investors right now?
Best advice for passive investors right now, I would say really get to know your sponsors. I think that's advice in any market. But I also think if you're a brand new passive investor, I would say if you get really excited about a deal and you have not invested in a deal before, maybe say no and look for 4, 5, 6 more before you decide to pull the trigger, because there's a lot of sponsors out there. There's a lot of different markets and types of real estate deals you can do. And I think that there's going to be opportunities in the next month. There's going to be opportunities in the next couple of years, but just taking the time to really understand the sponsor, understand the deal, and review a good number before you pull the trigger, I think is wise.
What's some of the most important metrics that you track? Could be personally or professionally.
We're definitely big on KPIs. So we have a dashboard that we meet as a team to review every single Friday. So, just a few I have it right in front of me right here. So we have various KPIs on the investor relations side, on the acquisition side, on the asset management side. So I'll just give you a couple. We track how many new deals were generated every single week. The goal is 15 new deals a week. How many deals were underwritten every single week? New deals. We typically try to hit at least 5 a week. And then on the LOIs front, we try to submit at least 2 LOIs every single week. So, we've got 10 other ones that I won't go through, but the point is we're definitely tracking KPIs on every division within our company. From the personal side, I would say that the most important things to me is just consistency. So my day kind of looks the same every single day. I cannot sleep unless I get at least, a workout in every single day. So it's not necessarily something I track. It's more like, just brushing my teeth. Every single morning I'm waking up and I'm kind of going through the same routine, and that just helps me stay sharp. Like if I don't wake up and get me time out of the way before I get into meetings and start evaluating deals, I just feel like I don't make as good of decisions throughout the day. So really consistency is just kind of the big focus for us.
Yeah, love that. I can relate to that in that morning routine completely. It makes such a big difference. If I have to get up late for some reason, of course, we've had a new baby here recently. And so that's kind of threw my morning routine out the window for a number of weeks. And I'm just getting back on track now. She's sleeping really good now. So it's like, okay, now I can finally get, some time in the morning to get my head straight right before kids are up and the meetings start and all that. So completely understand. Any habits that you're disciplined about that produce a higher return for you?
Yeah. So couple things. I already kind of got in the morning routine, so I'll work out every morning before the day starts. Luckily, I have an awesome garage gym, so I don't have to go far, and it makes it really easy. Other thing on the kind of personal health side, I typically fast until noon every day, which enables me just to kind of stay sharp. I feel like when I eat, I slow down a little bit. So that's one kind of habit that I stick to just about every single day. And then usually from a scheduling standpoint, I try to get all my work done, really difficult work done before 2 p.m. And then I usually take 2 p.m. to like 5 or 6 just to knock out phone calls and catch up with people. So that's really where kind of the deal generation happens, the new investor conversations happen, and just trying to block off the last part of the day where you've already spent a lot of your kind of thinking and energy. I think it's a way to stay productive, but also keep you from just, pounding through the spreadsheets all day long.
What's the number one thing that's contributed to your success?
I guess I'll give you two. One would be the consistency, and then two would be relationships. I think we kind of mentioned at the beginning of the call, it's just amazing how small of a world the multifamily world is. And there's thousands and thousands of people who know a lot more than I do. So just really following up with people and building those relationships, seeking first to add value, has just come back tenfold, and it's resulted in deals, new investors, new opportunities. So those are probably, I would give you two.
How do you like to give back?
Two primary ways. First is I've been involved with a group called Young Life. It's a ministry for high school, middle school, and actually college students. So I served in Young Life starting in college, and I served for 10 years until we actually just had our first son. So stepped back to spend more time with him, which is a ministry in itself. And then the second is I'm involved with a group called Apartment Life, which is actually a ministry that helps to really build community on apartment complexes. And it's something that we've done at a few of our apartment complexes. And that's a real passion of mine.
Love that. I appreciate you bringing up and serving in Young Life. Congratulations on the new baby or son. That's incredible. And then we use Apartment Life as well. So we've really enjoyed, it's been great to have them at our communities for a number of reasons. That's allowed us to pour back into tenants in ways that we never could have before. So appreciate you bringing that up. Kevin, I love your thought process that you brought to us today. What operators really need to be doing now, right? Getting in front of the potential opportunities that are most likely going to come. I think there are already some coming, but definitely over the next 6, 8, 12 months, I think there'll be more. And so I think it's so wise to segment, to be able to ensure you're prepared, just like you mentioned. I appreciate you laying that out for us today. How can the listeners get in touch with you and learn more about you?
So best way would just be to go to our website. It's www.rockbridgeinv.com, and you can fill out a contact us form there. I'm also on LinkedIn, Kevin Dean. Those would be the two best ways to reach out.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.